Every year, millions of people walk into a dealership believing they're making a smart financial decision. Some choose to buy, others choose to lease, and almost everyone believes their choice is the better one. But when you strip away the marketing, the showroom lighting, and the promise of low monthly payments, one question remains. Which option actually costs less over time? The answer is more complicated than most people think. Because the real cost of owning a car isn't just the monthly payment. It's depreciation, interest rates, resale value, maintenance, taxes, loan terms, and sometimes the emotional feeling of ownership itself. Today, we're breaking all of it down. Not from the perspective of a dealership, not from the perspective of advertising, but from the numbers. And once you see the math, leasing and buying start to look very different. Right now, car ownership has become dramatically more expensive. Auto loan rates are significantly higher than they were just a few years ago, and the average monthly payment for a new vehicle in America has climbed to nearly $730 a month. For many people, that number alone pushes them toward leasing. At first glance, leasing feels cheaper. The payments are lower. The car is newer. Maintenance is usually covered. And every few years, you get to drive something different. But leasing a car is fundamentally different from buying one. When you lease a vehicle, you're not paying to own it. You're essentially renting it for a fixed period, usually around 3 years. At the end of that term, the car goes back to the dealership unless you choose to purchase it. And during those 3 years, your monthly payment is covering 4 main things. First, depreciation. Cars lose value over time, and with a lease, you're paying for the amount the vehicle declines in value while you drive it. If a car starts at $30,000 and is worth $20,000 3 years later, your payments are largely based on that $10,000 loss. Second, interest charges. Even though you don't own the vehicle, the leasing company is still financing the car's value during the lease term, so they charge interest, often called a money factor. Third, taxes. And fourth, dealership fees and lease-related costs. That structure is why lease payments are usually lower than finance payments. You're not paying off the entire vehicle. You're only paying for the portion you use. Let's put real numbers behind this. Imagine a Toyota RAV4 hybrid with a retail price of roughly $31,500. Now let's say you lease it for 3 years with a $3,000 down payment. The lease allows 12,000 miles per year, and at the end of the contract, the dealership gives you the option to buy the vehicle for around $21,000, known as the residual value. That residual value matters because it represents what the leasing company predicts the car will be worth after 3 years. In this example, the monthly lease payment comes out to about $394 per month. Over 36 months, plus the down payment, the total cost of leasing the vehicle reaches roughly $17,184. At that point, if you wanted to keep the car permanently, you'd still need to buy it for the residual value of around $21,000. So in total, leasing the vehicle and eventually buying it would cost approximately $38,000. Now compare that to financing the exact same car. Same vehicle. Same $3,000 down payment. But instead of leasing it, you finance it over 5 years at a 6% interest rate. That brings the monthly payment to around $551 per month. Over 60 months, the total amount paid becomes roughly $36,060. Already, financing is slightly cheaper than leasing and then buying later. But this is where the comparison becomes more interesting. Because when you finance a vehicle, you still own an asset at the end. And vehicles like the Toyota RAV4 tend to hold their value relatively well. After 5 years, estimates suggest the vehicle could still be worth around $24,000 to $25,000 on the used market. So if you sold the car after those 5 years, your true ownership cost wouldn't be the full $36,000 you paid. It would be the difference between what you paid and what you recovered from selling it. In this case, around $11,500 total over 5 years. That changes the equation completely. But there's another problem. Comparing a 3-year lease to a 5-year loan isn't exactly fair. So let's shorten the financing period to 3 years instead. Now the monthly payment jumps significantly, around $866 per month, because you're paying the loan off faster. But the total cost of the vehicle drops to roughly $34,000 because far less interest accumulates. And after 3 years, the vehicle can still be sold for an estimated $26,000. That means your actual cost of ownership over those 3 years would be around $8,000. Compare that to leasing the same vehicle for 3 years at over $17,000 spent. Suddenly, leasing looks dramatically more expensive. But there's an important detail many people overlook. Sometimes, the residual value in a lease contract ends up being lower than the car's actual market value, especially in a strong used car market. In other words, the dealership might allow you to buy the vehicle for $21,000, even though the car could realistically sell for $26,000 on the open market. That creates an opportunity. A person could lease the car, purchase it at the discounted residual value, then immediately resell it at market price. When you factor that into the math, the effective cost of leasing drops significantly. In this scenario, the total cost of leasing falls closer to $12,000 over 3 years instead of $17,000. Still more expensive than buying, but much closer than it first appeared. And that leads to the bigger conclusion. For most people, buying a reliable car and keeping it for a long time is usually the more financially efficient decision, especially if the vehicle holds its value well. The longer you keep the car after paying it off, the more the economics begin to favor ownership. Because eventually, the monthly payment disappears, but the car remains. That said, leasing isn't automatically a bad decision. In certain situations, it can make a lot of sense. Luxury vehicles, sports cars, and high-maintenance brands often depreciate aggressively. Leasing protects drivers from long-term repair costs and rapid value loss. Some people also simply prefer driving a new car every few years. For them, leasing offers predictability. Business owners may benefit from tax deductions tied to lease payments. And many leases include warranty coverage for the full term, reducing concerns about repairs and maintenance. But leasing comes with trade-offs. Most contracts include mileage restrictions. Exceed those limits, and the penalties can add up quickly. Ending a lease early is often expensive. And at the end of the agreement, unless you purchase the vehicle, you walk away with nothing to show for years of payments. So ultimately, the decision comes down to what you value most. If you want the strongest long-term financial outcome, plan to keep a car for many years and appreciate ownership. Buying usually wins. But if you prioritize lower monthly payments, newer vehicles, warranty protection, or flexibility every few years, leasing may fit your lifestyle better. Because in the end, this debate was never really about cars. It's about understanding the true cost of convenience. And sometimes, the cheapest monthly payment ends up being the most expensive decision over time.